Brad Williams, Frugal Finance, talk about stock. Let's talk about stock you own in the company you work for. Let's talk a little more about whether that's in your retirement plan, whether it's in a direct stock purchase plan, whether it's stock options, or if you're just an investor. Key thing here, diversification. You may find yourself in a position as an executive where your compensation is heavily weighted in terms of stock options or 401k or special compensation, golden parachutes, so on and so forth. The conversation here is, how do you acquire company stock? How much should you own? And should you diversify? Invest in what you know. That's bottom line. If you're a beginner, without going too far off topic, if you're looking at buying stocks, buy stocks in company that you know something about. If you're a retailer, you know a little bit about Walmart or Amazon or Target, well, you may do a little more research in that department. If you're in the medical field, perhaps you may find some interest in pharmaceutical or in the healthcare industry, so on and so forth. But it's common knowledge. It's a common investment adage, and employees might think that they know their employer better than anyone else. But should you invest in your company stock? Owning a stake in a company you work for might have some advantages. You might feel optimistic about your employer's futures and want to share in the wealth. As an employee, you may even be able to purchase stock at a discount. However, there are risks you should consider. A key risk is overconcentration. It's never smart to put all your eggs in one basket. Investors generally should aim to have a diversified investment portfolio. That's especially true when it comes to investing in stock in the company that employs you. With anything related to business, there's the teeter-totter effect. There are earnings, there are good times, and there are bad times. Your stock, publicly traded, or for that matter, any particular stock, its value is going to fluctuate based on future earnings. How might I end up owning my company stock? Well, there are a couple different options. You can take advantage of your retirement plan, and if a company's offering you stock, clearly don't ever throw away free money. Take advantage of it. You may have an employee stock purchase plan. You may have an employee stock ownership program, and I'll have videos on all of this stuff later. And this article will be posted below, so you can link to all this stuff if you call up this particular article. Your company might also offer employee matched retirement contributions in the form of company stock or in the way of stock options. If you receive company stock as part of your compensation or benefits, by all means, take advantage of the free stock. However, if you're compensated with stock or stock options, be particularly mindful of the benefits of diversifying your portfolio. Loading up on company stock in a taxable investment account while also allocating a percentage of 401k to company stock can leave you under-diversified. In other words, if you work for ABC in your retirement, pretty much just the company stock, you may think twice about all your eggs in one basket. If I own company shares, can I sell them when I want? Yes and no. Are you tenured? Are there restrictions? Are there lockout periods? Is there a stock option? There's a lot of what if. So within your 401k, your company might place restrictions on your ability to buy or sell the stock or transfer it to another type of investment within your retirement plan. This is all about spending time reading your benefit, your company benefits. Talk to human resources and ask them. Employer matched stock in particular often comes with restrictions. Some companies require employees to hold the company stock until they reach a certain age or until a specified date. It means if it's tenured. This might cause problems for you. If the stock slides, you may be stuck on the sidelines without the ability to sell. Lockdowns or blackouts can also occur. These are periods in which account activity is frozen, generally to perform administrative tasks. Usually lockdowns are for short periods, few days to a few weeks, with employees given advance notice. When it comes to qualified employee stock purchase plans, there are rules associated with how much you can purchase and the timing of the sale of shares. Read your company ESPP information carefully and consider consulting with a tax specialist. How much company stock is too much? As a general rule of thumb, some say 10%. You have to make that determination on your own. You want to make sure that you have a fully diversified portfolio. If you crunch the number, the general rule of thumb is a portfolio of 13 to 15 different stocks is a pretty well-balanced portfolio. There's some number crunching. And if you're interested in the number side, I have 22 courses at frugalfinance.net. They're very informative. It's purely the math side or the quantitative side to investing. If you're interested, take a look. The bottom line, owning company stock might allow employees to share in the financial success of the company, but also carries the risk that the employer's financial problems will become your financial problems. Be smart about the degree to which you're willing to tie your finances to a single company, even if the prospects look bright. Comment, let me know. Brad Williams, Frugal Finance. Thanks for watching. See you soon.